When it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your, ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? As recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. So the standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. We're in a recession right now, and there's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. Stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right, so you're expecting a major correction in stock markets.
I mean, that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions. And they're saying the same thing. So, so every now and then someone will throw some statistic at me. And I go, well, how long is your time series? And I go, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world. 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So I do. That is my view, but it's shared by a number of other analysts. And again, you have to remind people. 1929, everyone's like, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. That wasn't the crash. I mean, that was the beginning of the crash. The Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932, started in October 1929, so not quite 3 years. But that fell 82%. NASDAQ's down, bounced back a little bit in recent days, down close to 30%, down the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a fair market full adjustment looks like in the face of the kind of recession that I expect. I started my career in banking in 1976, and so my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. It had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. We're putting up inflation numbers today that are the highest in 40 years. That is correct. But I remind people, inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning. You say, that's inflation. Yeah, we did. But it had started. I mean, some ways it started in 1968 and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power. 15, 50 in that 5-year stretch. So you were putting up numbers 10%, 11%, 13% and higher year after year. Yeah, 1981, it was 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years, or is it different than that? But keep that in mind, because the 40-year comparison, it is correct. That was the tail end of an even worse episode. Inflation, you just look at 2022, starting in January, it was kind of like 7%. And then it was, it's 8.1, it's 8.6, now it's 9.1, which is true. That is the series. It is going up. So people extrapolate that. And again, there is this comparison to the 70s. By the way, I think the situation we're in today is very different from the 1970s, and I'll explain why. Well, let's explain why right now, because in the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war, and then the price tripled, but it went from like $2 to $6. Okay, but then it got to 12, and then in 1979 you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that, and then it went from kind of 12 to 20. Oil went up by a factor of 10 in the course of the late 70s because of those two different embargoes. So that's coming from the supply side. But what happened was the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supply's choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, hey, better spend the money fast because it's losing value. And you see that in inflationary expectations and inverted yield curves. If you thought inflation was going to run away, as it did in the 70s, the yield curves would be steeply sloping. What the yield curve is telling us, what inflationary expectations are telling us, and other factors are telling us, is that, yeah, there's inflation now, but the Fed's going to kill it, and they're going to kill it by destroying demand and throwing us into a recession. And here's where it gets interesting, because you could flip from this kind of inflation to disinflation or even deflation very quickly. And people are definitely not prepared for that. Well, I'm sorry, I shouldn't say that. Kind of everyday consumers are prepared for it. I'm not sure Wall Street and mainstream economists and policymakers are prepared for it. They're just extrapolating the inflation, saying, well, the Fed's going to kill it. Yeah, they might kill it, but at a price, at a very steep price. And consumers are really bracing for that. So even Jay Powell said the soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. But that's not priced into markets. The markets are kind of pricing in a squishy landing.